Hi, so did you know there are about 30 different reverse mortgage products and options? I'm Jay Zayer. I'm a certified reverse mortgage professional, and I've been helping homeowners for 18 years. Today I'm going to explain how a reverse mortgage actually works, who qualifies, and what your options are. Let's start with the basic mechanics. A reverse mortgage is a loan against your home. You keep the title, you keep the deed, the lender records a lien, exactly like they do with a regular mortgage. Nothing about your ownership changes. The difference is the payment. With a regular mortgage, you send money to the bank every month. With a reverse mortgage, you don't. The interest gets added to the loan balance instead of coming out of your pocket. That balance grows over time, and it gets repaid when you sell, move out permanently, or pass away. Here's the protection that matters most. It's called the non-recourse guarantee. You can never owe more than the home is worth. If the balance grows past the value of the house, FHA insurance covers the difference, not you, not your estate, not your children. Okay, so who qualifies? The federal program requires you to be 62 or older. If you're married, we look at the age of the younger spouse. There are also private reverse mortgages that start at 55. Another benefit of the private reverse mortgages are they can go to a much higher loan amount, in some cases a few $1 million. Most borrowers will need to have at least 50% or more in equity. If you still have a mortgage on your home, that gets paid off first from the reverse mortgage proceeds, and whatever's left is yours. You can receive the proceeds in the form of a lump sum, monthly payments, set up a line of credit which you can draw from as needed, or any combination of these options. There is no credit score requirement. What we do look at is called the financial assessment. We're checking whether you can keep up with the property taxes and the homeowner's insurance going forward. If your numbers are tight, the lender can set aside part of the loan to pay those bills for you automatically. You have to live in the home as your primary residence. It has to be where you actually live. And for as long as you have the loan, you continue to pay the property taxes, you keep the insurance active, and you maintain the home. Now let's talk about your options, because this is where people leave money on the table. There are 4 ways to take the money, and you can combine them in a way that will maximize the benefit to you. The first is a lump sum. You take it all at closing. That's the right choice if you're paying off a large mortgage. The second is 10-year payments. A fixed amount every month for as long as you live in the home. It doesn't stop. You can't outlive it. If your problem is that your monthly income doesn't quite cover your monthly expenses, this is usually the answer. The third is term payments. Same idea, but for a set number of years. People use this to bridge a gap, like delaying Social Security until 70, so that check is permanently larger for the rest of their life. The fourth is a line of credit, and this is the one almost nobody understands. You set it up and you don't have to touch it. The unused portion grows at roughly 7% a year. A $200,000 line of credit today is about $400,000 in 10 years. And unlike a home equity line from a bank, the lender cannot freeze it or reduce it. Not if home values drop. Not if your credit changes. Not ever. That's the part that makes this different from every other way of borrowing against a house. Everything I've discussed with you so far is the same for everyone, but the actual proceeds depend on 4 things: your age, your home's value, your existing mortgage, and the interest rate. Change any one of those and the numbers change. Let me give you 3 real examples of where money gets lost. First, every lender can charge an origination fee and sets their own interest rate margin. The government caps the origination fee at $6,000, but the truth is in most cases there shouldn't be a need to charge an origination fee. The margin varies more than people realize. A quarter-point difference in margin doesn't sound like much. Over 20 years, it could end up being the difference of tens of thousands of dollars. Most people never compare 2 offers because nobody tells them they should. Second, if your home is worth more than $1,249,000, the government program stops counting above that number. That's where the private reverse mortgage programs that use your full home value instead start to make more sense, and they don't charge the FHA insurance premium, which on a high-value home is almost $25,000. If nobody runs both programs side by side, you'll never know which one was better for you. Third, and this is the one I see most, if you refinance during 2020, 2021, or 2022, you might have a mortgage at 3%. A standard reverse mortgage pays that off and it's gone forever. But there's a second position product that sits behind your existing mortgage and leaves that 3% rate completely intact, while still giving you payment-free access to your equity. So this reverse mortgage second can be a great option for homeowners that want to continue to make their first mortgage payment and are looking for additional funds. A reverse mortgage can have anywhere between $0 to $35,000 in closing costs. If you're planning to move in the next 2 or 3 years, you won't get that back, and I would probably recommend not going with an FHA option. For shorter term periods, the proprietary or private reverse mortgage can be a very useful option, and in many cases, the closing costs can be close to zero. If you want to know what your specific numbers look like, just call me at 760-271-8646 or book a time at reversemortgage.coach. Don't guess at this. A 5-minute call could save you thousands. It's free and there's no obligation. Have a great day and look forward to talking with you.